Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. And I'm not even going to do much of a preamble today because, frankly, it is obvious what we are going to talk about. And so let's just go ahead and put it right on the screen here because clearly we are going to be talking about the Fed. We've been waiting for this announcement for some time. Expectations have been churning. The markets are active. So let's dive right in. There is a lot to cover. This is going to be a critical policy announcement. First, let's consider expectations. So what are we actually going to see tomorrow as far as the markets are concerned? Well, here it is. 86% probability that we are going to get a 25 basis point rate hike. That's the top line there. ARM, you can see the far column on the right. That's the average rate move. You can see it's at 0.25, which means a standard move is 25 basis points or 0.25%. Now look at the implied rate delta column and you see 0.216 or 0.22. So 22 of the 25 basis points of a standard hike have already been priced into the market. From there, things clearly start pointing to this being the top in rates. As you can see, all of the numbers thereafter now look negative. So you are at this point looking at rates peaking at this meeting. So we now have all of this rate hike being taken away with a 77% probability by November. So you can see rate cut odds start building immediately after this meeting. You can see June, it's fairly low, 5.3. In July, a third. In September, about 50-50. By the time you get to November, you can see that the implied rate delta is minus 21 basis points. So you've priced in 21 basis points in cuts as relative to right now, which essentially tells you that not only have you taken away the hike we're about to see, but you've actually gone down one, almost. Come December, we're talking about being down two, almost. You can see the likelihood there of 68% that we're going to get 50 basis points in net cuts as relative to where we are currently. So before tomorrow's hike. Which means that after tomorrow's hike, we're looking at the strong possibility at this point of having 3 cuts that follow. So this is now looking quite like a quick reversal. Now, the Fed, for their part, have said that they are not looking to cut rates this year. At least that's the last thing we've heard from them at the last policy announcement on this subject. So that was the last official communication, if you will. And here's what the pathway looks like, both since we had the collapse in Fed rate hike odds with the start of the SVB-led banking crisis in early March, and then where we have gone since the last Fed announcement toward the end of March. So obviously you can see the curve here has significantly flattened, even as relative to last week. Needless to say, it's gone down quite a bit since the SVB collapse. And this is its own interesting part of this story, which we'll get into momentarily. But the curve is down even relative to last week at this point. And you can see here the current policy rate 4.88. You can see the hike there for a peak at 5.1. And from there, the curve rolls over. So what we are essentially looking at here is peak rates after tomorrow's hike. And the question then really is, how deep of an easing cycle follows, and how offsides are the Fed and the markets as relative to each other? What's the disconnect, and how much of an adjustment is there to make across assets? And incidentally, how is it that the curve continues to drift down? What's going on here in this economy that we are getting a flatter curve even as relative to last week? Let's do a bit of investigating. So in the dark there is the OFR Financial Stress Index, just a measure of credit risk. And in the orange is where the Fed funds rate is expected to be, looking at what's implied in futures markets 12 months forward from any given day. So essentially, it's a running 12-month view, a running 1-year outlook for Fed policy. Notice, when you get the initial jump in credit stress, Fed rate hike odds collapse. They then basically hold within this range, even as credit stress appears to ease. And of course, we've had a bit more consternation here today, but it certainly hasn't spiked back to these levels. And so what you see here is seemingly a disconnect. On the one hand, credit stress is easing. On the other, this is not moving inversely. It's not going up. And naturally, the question becomes, well, why is that? If these things were symmetrical on their way into the banking crisis, why are they not symmetrical going out? What is it that the market is perceiving? You see something similar in the way that risk has behaved, although there's been a little bit more of a rebuild here. But as you can see, credit stress continues to ease for quite a bit longer after the S&P essentially runs once again into that February peak thereabouts around the 4,200 area and then stalls. So again, the question becomes, why is it, if the drop is mainly about credit risk and the banks, why aren't Fed rate hikes improving? And why isn't risk more buoyant? Why isn't the stock market more optimistic? Well, we can see here that U.S. economic data appears to be rolling over. We appear to be having significant deterioration in U.S. economic data outcomes as relative to expectations. And the flow there seemingly suggesting that maybe the source of concern here is not so much the banking crisis as it is the business cycle itself, whereby the Fed's efforts to cool the economy and thereby bring down inflation, given the long lags of policy, are finally starting to really bite. Now, you see evidence of this elsewhere. So you can see, because what the Fed is doing is raising the cost of borrowing dollars and thereby making the world's most important transactional currency more expensive to borrow, and thereby making all economic activity around the world more difficult to finance, that the Fed's efforts are indeed cooling global demand. This is a proxy for it by looking at the overall total global volume of trade, both imports and exports. And you can see here very clearly there has been a decline in demand, and it is, as the Fed might have intended, bringing down inflation. This is that part of the story that ostensibly is working exactly as the Fed would want on a global level. It's also working on the sticky parts of the economy that the Fed has been the most concerned about, the part that was going to retain inflation longer. We just got data this morning that U.S. job openings have moved significantly lower than expected, as a matter of fact, that are now at 9.6 million. That's a meaningful climb down from the peak at 12 million in the wake of COVID. So what we're looking at here is then the U.S. jobs market rolling over, which, as we've talked about here, is a critical input into the Fed's calculus, because it works into the labor supply and demand balance that has kept inflation elevated beyond what's going on in global conditions, shipping conditions, those elements of inflation that the Fed used to call transitory. So here, what you're looking at is the supply-demand balance surging positive during COVID. That's right here. And that is, of course, because the economy gets locked down. Suddenly, there's all this labor and not much demand. So supply significantly outstrips demand. As that balance starts to close with the reopening of the economy, so too inflation starts to creep higher. And as you come out of COVID, you can see a very different kind of mismatch, where here demand significantly outstrips supply. Not surprisingly, that's very inflationary. You can see now that over the past 4 months, and certainly with this job openings data for March that we saw this morning, you now have a concerted direction to reduce this gap, and that's starting to eat into inflation further, which again is exactly what the Fed is after. But what it means is that labor demand is falling. This is now the smallest mismatch since September of 2021, and seems to point to the U.S. labor market weakening. Now, the markets have noticed. What you see here in the yellow bars is the 2-year break-even rate, which is essentially the market's priced-in inflation expectation over a 2-year period, which is right within the Fed's outlook window. And what you see here, first of all, the way you arrive at this, just really quickly for the uninitiated, it's the difference between nominal bond yields, which is what we typically talk about when we say the Treasury yield is XYZ thing, and real yields or TIPS yields, which have been adjusted for inflation. If you take the difference between the adjusted and the unadjusted, you come up with the adjustment magnitude. And that's what gives you the bond market's running inflation expectation. As you can see here, the 2-year break-even has been leading official CPI and PCE numbers by about 2 months. And it is now at 2.1%, which tells you that within about a 2-year period, the Fed is essentially on target. Now, if you are somewhere between 4.2 and 5 on observable inflation, and expectations are going to 2, then the question becomes, well, what has to happen over 2 years that we are going to get from 4.2 or 5 down to 2? Well, ostensibly, it is more of the economic pain that has gotten us here. It is the rolling over of the U.S. labor market. It is a deepening of the decline in economic activity. Otherwise, how do you get there? And so the key now then for markets seems to be, well, this is why the Fed would pause here. This is why we are perhaps looking for a peak in Fed rates with this last hike. Because the market seems to have seen enough in the economic data and perceived enough of it deteriorating, as we've just seen, and economic conditions mirroring that deterioration, needless to say, that the market has concluded the Fed is on a path to get to its inflation target at this point, because the amount of tightening that has already occurred as it, in the coming quarters, fully works its way through the economy will continue to squeeze us down to about the target level. In other words, the market seems to be signaling that the Fed's job is essentially done, and it can basically take a step to the sidelines, leave the situation on autopilot, and over the course of 2 years, credibly get to where it's going. The flip side of that coin is that the market sees significant economic pain without the Fed doing any more tightening. Because how else are we going to get from 4.2 or 5% inflation to 2.1? And so what we're seeing against this backdrop, as we've talked about here before, is a very different kind of relationship between what Fed policy odds do and how markets react. Notice here that going into the banking crisis, we've made this point before, it's worthwhile to make it here again. As Fed odds were building, as the Fed policy outlook was getting more hawkish in February, risk didn't like it. And then with the banking crisis, there seemed to be a change in perspective. As Fed rate hike odds collapse, you can see Fed rates and risk align. Stocks are falling here. Not surprising. Needless to say, they were spooked by the banking crisis and the specter of the last time we've had major bank failures, which of course didn't work out very well at all. Be it either the episode in 08, 07, 08, which is the most dramatic, clearly, and the one freshest in the minds of investors, or for that matter, the savings and loan crisis in the 1980s. Less dramatic, but nevertheless quite painful. And also against the backdrop of a Fed rate hike cycle that was quite aggressive. Then, as you get the rebuild here, risk improves. You can see Fed rate expectations nudge up as things normalize, and then right here, there seems to be a pointed change in the way this works as relative to here. Because you can see that as the recovery in Fed policy odds stops and things actually start to edge back down, risk comes in as well, signaling that we are no longer in a place where easing Fed rate hike expectations are a risk positive. They would be if this was a generally well-supported economy that the market feared was being held back by the Fed, of course, entirely by design. Instead, the deterioration of Fed rate hike odds here, or at least the stopping of their rebuilding from banking crisis lows, being accompanied by a deterioration in stocks tells you the markets now see a growth concern here and have increasingly become worried about recession. We see something similar show up in the dollar. The dollar was building higher with Fed policy expectations back in February. We can see that here. It was impressively strong when the banking crisis initially occurred and really only started to slide once the improvement occurred, ostensibly as capital came out of cash and into riskier assets again. We, of course, can see that here with stocks rising. And then once again here, near term, we are looking at a situation where as Fed rate hike odds now anchor and start to dip, the dollar actually is getting stronger, which is the inverse of what we see here. And much more like what we see right here at this peak, where just as Fed rate hike odds go down, the dollar is actually strongest and really only starts to slide once this bottoms. That's the dollar behaving not as a currency lifted by the prospect of higher interest rates. We've talked before about scenarios where the market is concerned about returns and is generally optimistic. Rising rates benefit a currency because one person's borrowing cost is another's lending income. And so if rates rise, that means that currency can be lent out for a higher rate. And that, of course, increases demand for that currency. People buy it, it rises. Much like you might expect, all things being equal, for there to be a demand for a stock if its dividend were to rise. It would then pay a higher income stream to hold. That would make it more attractive as relative to before that dividend increase. Rate rises generally for currencies work in a very similar way. What you see here is a sort of transition for the dollar, where it now is finding gains not in that dynamic, but in the dynamic where the market doesn't so much care about returns, but cares about liquidity and safety, and is cashing out of riskier assets, having seen Fed rate hike odds idle and start to dip, not because they are enthused about the market being unshackled and the tightening cycle removing itself as a hurdle, but because the consequences of that tightening cycle appear to be driving down economic growth and raising recession odds. And of course, this follows the dynamic we've been talking about here on Macro Money for months and months, which is the dollar smile framework. And what you see here on the right-hand side is what we saw in February, when the U.S. appears stronger and U.S. economic data appears robust, as we saw then. There is a positive yield story lifting the dollar. It gains with policy tightening expectations. And then when the pendulum flips and we get into a situation as we are now, when it looks like U.S. data is floundering and the market is increasingly concerned about recession, the dollar gains yet again. This time because it is the unrivaled currency powering global commerce. There is no alternative. I know there's a lot of de-dollarization stories out there, and I've made no secret of my opinion that they are utter nonsense. There is just simply not a more liquid currency in existence. And the more liquid something is, the more buyers and sellers there are. And the more buyers and sellers there are, the smoother one can enter and exit that currency. So if there is mass liquidation of risky assets, where does that capital go? Well, not surprisingly, it goes into the US dollar, the currency best able to absorb it without too much consternation. And so, not surprisingly, when the world's largest economy underperforms the rest, as we see on the left-hand side of this chart, the dollar strengthens. Not because it is reflecting the prospects of the U.S. economy in a positive fashion, but actually quite the opposite, because it's reflecting its negative prospects. And the implications of that for global growth overall, mass liquidation overall, a broad-based move out of assets into cash, and for the dollar, that of course is beneficial because it is the cash of choice in that kind of scenario by virtue of that liquidity. And so as we go into this Fed announcement, and the market is seemingly positioned for this being the last hike, we are perhaps at the moment where the object of speculation finally turns. And rather than speculating on what the Fed might do next, what's it going to do at the next meeting? What's it going to do at the meeting after that? Where is the peak in rates going to be? All of those questions are ostensibly answered and just need confirmation with tomorrow's announcement. At which point the question becomes, why is the Fed stopping now? And that becomes a story about recession based on what we're looking at here. And so we might very well be in a situation where the Fed announces its last hike, signaling that perhaps it is on pause now. You almost certainly aren't going to commit to cuts in a transparent, we are definitely going to cut this much on these dates kind of way. But if the Fed signals that it is all but done, if not done, the market might very well read that as confirmation of these recession fears that have been building. And the net outcome might be weaker stocks and a stronger U.S. dollar. A kind of buy the rumor, sell the fact response, as relative to how these relationships have worked really since the middle of 2021, where the Fed started the march toward rate hikes that ultimately then began in March of last year. And of course, this comes at a very auspicious time. This is the monthly chart here for UUP, the Invesco bullish US dollar ETF, basically tracking the overall direction of the greenback. This all comes together just as we form a formidable bullish engulfing candlestick setup here, right at critical former resistance becomes support at 27.19. You can see that's the range top that was in play going all the way back to the dollar surge during the last crisis, 08-09. We overcame it with these most recent rate hikes last year. We've slumped back to retest, and now we appear to see signs of bottoming. It could very well be that this Fed announcement begins us on the next leg higher, and not for positive U.S. economy considerations, but actually quite the reverse. And that is macro money for today. Thank you very much for joining me as ever. I am here Monday through Thursday just after overtime, a show I do with Chris Vecchio, head of Futures and Forex, here at Tasty Live, where we recap the day's events across markets and look out to what might be coming next. I am also on with Tom and Tony for First Call on Sundays, and back on with Chris on Fridays for Futures Power Hour. Outside of those shows, you can catch me opining on Twitter at Ilya Spivak and writing for the Tasty Live blog. I'll have my outlook for the non-farm payrolls report later this week up there ahead of that. So do keep an eye out for that. And of course, we'll cover it in Macro Money as well. Good luck out there, everybody. We'll see you on the other side of the FOMC announcement. Take care.